Chapter 10. The Rise of the Megacorporation, the Capital Problem, the Mathematics of Risk.
To understand the birth of modern finance, one must first look at a wrinkled, unassuming blackberry. Black pepper, the dried fruit of the Piper nigrum vine, fundamentally rewired the economic architecture of the world. For centuries, the pungent spice had been a luxury of the highest order, ferried across the globe by Austronesian sailors, Arab middlemen, and Venetian merchants. The overland Silk Road and the ancient Red Sea maritime routes were agonizingly slow, prone to banditry, and ultimately severed by the rise of the Ottoman Empire. To keep their winter meat palatable and their social status secure, Europeans desperately needed a direct, uninterrupted maritime route to the source. The Portuguese were the first to solve the geographic puzzle, rounding the treacherous Cape of Good Hope in the late 15th century. By establishing the Carrera de India, they bypassed the Mediterranean monopolies and connected Lisbon directly to the Malabar coast of India. However, their royal trading house, the Casa de India, was a fragile, bloated, and highly indebted state-run entity. The Portuguese crown bore the immense shipping costs, while private syndicates handled the European sales, a structural imbalance that left the monarchy perpetually strapped for cash. By the end of the 16th century, the Portuguese grip on the spice trade was violently contested, and the supply of pepper to northern Europe became erratic. As the middle class expanded during the Renaissance, the demand for pepper, cloves, nutmeg, and mace reached a fever pitch across the European continent. The potential for staggering wealth was obvious to everyone. A single ship packed with Indonesian spices could generate returns exceeding 400% of the initial investment. However, the barriers to entry for northern European merchants attempting to capture this market were terrifying. The sheer geographic distance to the Indonesian archipelago and the Indian subcontinent presented a logistical nightmare unparalleled in human history. To reach these lucrative markets, European merchants had to navigate violent oceans, survive sudden typhoons, and fend off heavily armed Iberian galleons. The most brutal barrier, however, was the staggering cost of human life. The mortality rates on these early voyages were little short of apocalyptic. It was not uncommon for a major exploratory fleet traversing the Indian Ocean to lose half of its crew to scurvy, dysentery, and ship fevers before ever sighting the coast of Java. Shipwrecks were a constant, terrifying reality in the age of sail, with a significant percentage of all vessels lost to the crushing waves or hidden reefs of the southern hemisphere. A sailor embarking on a 2-year round trip to the Malabar coast was effectively rolling the dice on his own survival. The financial mathematics of the early spice trade were equally brutal and fundamentally broken. Outfitting a proper maritime expedition required astronomical sums of capital that dwarfed standard European commerce. In the early 17th century, the construction and equipping of a standard Dutch cargo ship, known as a float, could cost upwards of 10,000 guilders. Meanwhile, a massive, heavily armed East Indiaman required to survive the Asian trade routes could demand an investment of 100,000 guilders. This was an unimaginable fortune during an era when a prosperous, well-off merchant might only earn 500 guilders in an entire year. The English faced similar hurdles, with fully outfitted trading vessels routinely costing between £10,000 and £12,000 sterling. In this era, maritime trade was financed through a primitive, isolated model of investment known as a single voyage partnership. A wealthy individual, a family guild, or a small monarch would pool their liquid wealth to purchase a ship, hire a desperate crew, and send them into the unknown. If the ship returned laden with pepper and mace, the investors became kings of commerce overnight. If the ship sank in the Gulf of Siam, or if pirates intercepted it off the African coast, the investors were instantly rendered bankrupt. It was a binary financial gamble that was mathematically unsustainable for long-term geopolitical growth. Small European monarchies lacked the fiscal capacity to continuously absorb such catastrophic centralized losses. Private merchants, no matter how wealthy, could not endure the total annihilation of their net worth if a single unpredictable storm decided to swallow their wooden hulls. Premium-based marine insurance existed, pioneered by Italian merchants centuries earlier, but the sheer scale and risk of the Asian pepper trade made comprehensive policies ruinously expensive. The risk was not just in the ships, but in the highly volatile value of the cargo itself. The cargo of a large East Indiaman was routinely worth 6 to 8 times the massive construction cost of the vessel. A single metric ton of freight could carry hundreds of kilograms of silver to purchase the spices, and the returning pepper commanded premium prices in European markets. Putting that much concentrated wealth into a single fragile wooden basket was a recipe for economic disaster. To truly conquer the global supply chain of black pepper, the merchants of Northern Europe needed a revolutionary financial mechanism. They had to find a way to separate the immense physical risks of the sea from the financial ruin of the individual. The capital problem was clear. The logistics of the Asian spice trade demanded fleets of heavily armed ships, permanent overseas fortresses, and massive silver reserves to trade with local sultans. These capital requirements vastly exceeded the resources of any single merchant house. The solution required an unprecedented leap of imagination, a legal fiction that would allow hundreds of strangers to safely combine their wealth. The invention of the joint stock company pooling the risk. The solution to the capital problem was a masterpiece of financial engineering. If the cost of a single voyage to the Indonesian archipelago was mathematically too high for one man to bear, the logical answer was to divide that cost among a multitude of men. This concept birthed the joint stock company, a massive risk-sharing engine designed to conquer the oceans and monopolize trade. By breaking the ownership of a vast trading fleet into thousands of tiny, affordable fractions, merchants could insulate themselves from the lethal realities of maritime commerce. If a ship went down in a storm off the Cape of Good Hope, no single investor lost everything. They merely lost a fraction of their total portfolio. The English were the first to formalize this concept on a national, monopolistic scale. On the final day of the year 1600, Queen Elizabeth I granted a royal charter to a group of ambitious London merchants, creating the British East India Company, EIC. This entity, initially known as the Governor and Company of Merchants of London trading into the East Indies, was granted a strict, exclusive monopoly on all English trade east of the Cape of Good Hope. The original founders of the EIC raised nearly £70,000 sterling from over 200 individual investors to fund their initial voyages. Their primary goal was to break the Iberian stranglehold on the Asian spice markets and bring cheap pepper directly to London. However, the early English financial model was still deeply flawed and overly cautious. Initially, the British East India Company operated by financing separate, isolated voyages. Investors would subscribe their capital to a specific numbered expedition, wait 2 or 3 years for the ships to return, and then immediately liquidate the profits and dissolve the capital pool. This constant cyclical assembling and dismantling of funds prevented the English from acting with long-term strategic vision. Because capital had to be returned to investors after each voyage, the EIC could not afford to build permanent stone forts, maintain standing armies, or establish long-term diplomatic residencies in India. It was a disjointed, short-sighted strategy that left them highly vulnerable to their far more aggressive neighbours across the North Sea. The Dutch quickly understood that to genuinely control the global pepper trade, they needed overwhelming, continuous force. In the late 1590s, various independent Dutch pre-companies had launched highly successful expeditions to the East Indies. However, their fierce internal competition was having a disastrous economic effect. They were driving up the purchase prices of spices in Asia while simultaneously flooding the European market and crashing the sale prices at home. Seeing the geopolitical folly in this, the powerful Dutch statesman Johan van Oldenbarnevelt forced these squabbling merchant houses to merge. On March 20, 1602, the Dutch government officially chartered the Verenigde Oost-Indische Compagnie, widely known to history as the VOC. The VOC was an entirely new species of enterprise, a corporate leviathan, legally engineered to operate as an immortal entity armed with extraordinary quasi-governmental powers. The Dutch government explicitly granted the VOC the authority to wage war, construct military fortresses, negotiate international treaties, imprison convicts, and even strike its own currency. To fund this massive geopolitical ambition, the VOC opened its initial public offering to every citizen of the Dutch Republic, regardless of their social standing or birthright. By allowing bakers, blacksmiths, orphans, and wealthy merchants alike to buy fractional ownership in the enterprise, The company raised an astonishing 6.44 million guilders in its opening weeks. The structural differences between the old methods of maritime trade and this new corporate model were stark, highly intentional, and brutally effective. The evolution of global commerce required a complete departure from the past. The old model relied on financing a single, isolated voyage with a predetermined expiration date, forcing merchants to constantly liquidate and rebuild their capital pools. The new corporate structure of the VOC utilized a continuous, immortal framework, allowing the company to exist indefinitely regardless of whether individual ships sank or returned. The old model concentrated the entire financial burden of piracy, disease, and shipwreck onto a handful of vulnerable private partners. The new corporate structure distributed that exact same risk across thousands of public shareholders, effectively neutralizing the threat of individual bankruptcy. The old model prevented long-term infrastructure investments, as capital had to be returned immediately upon a ship's arrival in port. The new corporate structure allowed for the construction of permanent overseas headquarters, naval fleets, and military fortresses, funded by continuously retained earnings. This transition to a permanent corporate state did not happen seamlessly. Initially, the original 1602 VOC charter actually stipulated a 10-year operational period, after which the company was supposed to present its ledgers, liquidate its assets, and return the capital to the masses. By 1612, however, the VOC directors realized that their massive, heavy investments in Asian military outposts and warships had severely drained their liquid cash. Liquidating the company at that moment would mean abandoning their hard-won infrastructure and surrendering the Indonesian Spice Islands to the Spanish or the English. Through intense political maneuvering, the directors secured a waiver from the Dutch government, permanently locking in the shareholders' capital and officially transforming the VOC into an immortal, permanent entity. To protect themselves from the incredible debts required to maintain a standing army in Asia, the VOC directors subsequently implemented another revolutionary concept: limited liability. In previous centuries, a merchant or director was personally responsible for the debts of his business. If his enterprise failed, his personal estate could be seized by creditors. By adopting limited liability for both shareholders and managers, a legal shield against total ruin, the VOC ensured its participants could only lose the exact amount they had initially invested. They invented risk pooling, a decentralized financial gamble, to outsmart the lethal ocean and rewrite the rules of global commerce. They utilized complex financial hedging to protect this permanent capital. In 1613, facing a severe cash shortage while outfitting their ninth massive fleet to Asia, the VOC directors drafted an unprecedented insurance contract. Rather than insuring the wooden ships themselves against storms, the 1613 contract ensured the revenues of the returning fleet, functioning effectively as an early European put option. By paying a 5% premium to guarantee a minimum return of 3.2 million guilders, the VOC secured the corporate continuation needed to fund their relentless expansion. This sophisticated financial engineering allowed the Dutch to maintain a massive, permanent fleet in Asia, ruthlessly enforcing their spice monopoly. The English eventually recognized the brilliance of the Dutch system and the crippling limitations of their own. After decades of struggling with the fragmented single-voyage model and facing near bankruptcy due to aggressive Dutch competition, the British East India Company finally evolved. In 1657, under the rule of Oliver Cromwell, the EIC obtained a new charter that officially transitioned the enterprise to a permanent joint stock structure. By permanently locking in their capital, the English were finally able to stop liquidating their assets and begin building their own sprawling infrastructure in India. Together, these two megacorporations used their innovative financial engineering to mitigate risk, monopolize the seas, and dominate the world's supply of black pepper, the first global stock market's trading paper for spice. The sheer scale of the VOC's capitalization created an immediate, highly practical problem for its thousands of everyday investors. Because the company's capital was now permanently locked inside the corporate vault, a citizen who needed their money back to buy a house, fund a marriage, or feed their family could not simply ask the VOC for a refund. The only way to liquidate their investment was to sell their fractional ownership to someone else who wanted a stake in the Asian trade. This pressing need for financial liquidity directly birthed the secondary market. The physical trade of heavy, pungent pepper directly necessitated the speculative trading of paper shares. In the early years of the 17th century, this financial trading took place entirely outdoors in the chaotic, weather-beaten streets of Amsterdam. Merchants, specialized brokers, and ordinary citizens would gather on the New Bridge, Nieuwe Brug, a stone structure near the bustling harbour, to shout out stock prices and negotiate transfers. They were surrounded by the raw, sensory overload of the Dutch Golden Age, exposed to the bitter winds of the North Sea. The air around the New Bridge was thick with the smell of raw Baltic timber, salty sea mist, and the sharp, intoxicating scent of exotic spices leaking from nearby wooden warehouses. As the volume of share trading exploded, moving millions of guilders in a matter of hours, it became clear that the financial engine of the Republic needed a permanent, dedicated home. The Amsterdam City Council recognized this and ordered the construction of a dedicated exchange building south of Dam Square. In 1611, the city officially opened the Beurs van Hendrik de Keyser, an elegant open-air quadrangle that served as the world's first formal stock exchange. Here, the trading of physical commodities like grain, whale oil, Baltic herring, and raw pepper took place directly alongside the frenzied buying and selling of VOC shares. The exchange operated under strict municipal rules, with share trading limited to a chaotic, high-pressure 2-hour window between noon and 2 o'clock each day. Brokers packed into the crowded, noisy courtyard, relying on handshakes and verbal agreements to move massive amounts of speculative wealth in mere seconds. However, transferring a share in the VOC was not a simple matter of handing over a beautifully printed paper certificate. In fact, the company did not issue physical bearer stock certificates in its early years to prevent fraud and maintain strict control. Instead, corporate ownership was meticulously recorded in a massive leather-bound ledger kept at the nearby East India House. When a buyer and seller struck a deal in the shouting courtyard of the exchange, they both had to leave the building and walk together to the company headquarters. There, they presented themselves to the official VOC bookkeeper. 2 company directors were required to physically oversee the transaction as the clerk dipped his quill, crossed out the seller's name in the Great Book, and inscribed the buyer's name alongside their new fractional ownership. It was a highly physical, localized process that grounded this new abstract financial wealth in strict bureaucratic reality. The primary reason these ledger entries held any value at all was the expectation of a massive payout. Investors had handed over their life savings to the VOC with the implicit promise that they would share in the immense, monopolistic profits of the Asian spice trade. However, during the company's first decade, the enormous sunk costs of waging war against the Portuguese and building permanent stone fortresses in Indonesia left the VOC severely strapped for liquid cash. When the directors finally succumbed to immense public pressure to pay corporate dividends, a physical payout of shared success, they resorted to a highly unconventional and controversial method. Because their vaults lacked silver and gold, they paid the shareholders directly in raw physical spices. The logistical absurdity of this system is difficult to overstate for a modern investor. In 1610, the VOC declared a massive dividend, paying investors 75% of their nominal investment value in pure mace. Shortly thereafter, they issued a 50% dividend in actual bags of black pepper. In 1612, they followed up with a 30% dividend paid entirely in Indonesian nutmeg. An ordinary Dutch baker, tailor, or widow who had invested a modest sum in 1602 suddenly found themselves taking delivery of hundreds of pounds of exotic, highly perishable cooking spices. The everyday shareholders were understandably furious at this corporate maneuver. They did not possess the commercial trade networks, the temperature-controlled warehouses, or the retail storefronts required to turn mountains of raw pepper into usable household cash. By dumping vast quantities of spice directly onto the local populace, the VOC inadvertently flooded the domestic market, causing the street price of pepper and nutmeg in Amsterdam to temporarily collapse. The directors of the company, who were themselves wealthy, connected commodity merchants, casually bought up the spice dividends from desperate lower-class shareholders at rock-bottom prices. By doing so, the executives effectively enriched themselves at the public's expense, turning their own shareholders into captive wholesale suppliers. This blatant market manipulation and lack of cash returns sparked the first great shareholder activism movement in corporate history. A wealthy, disgruntled investor named Isaac Lemire launched a furious public campaign against the VOC directors, accusing them of financial mismanagement, self-dealing, and intentionally withholding cash. Lemaire pioneered the concept of short selling, deliberately attempting to drive down the price of VOC shares on the open market to force the board into changing its policies. His aggressive speculative attacks panicked the conservative Dutch government, leading them to enact the world's first state regulations, attempting to legally ban the short selling of financial securities in 1621. Despite the financial chaos and legal battles, the pressure campaign launched by the shareholders ultimately succeeded. The VOC leadership realized that treating their retail investors as captive wholesale buyers was deeply damaging the company's public reputation and its critical ability to raise future debt. As the brutal military investments in Batavia and the Moluccas finally began to generate staggering, monopolistic cash profits, the company abandoned its spice payouts. By the 1640s, the VOC had transitioned almost entirely to paying its massive dividends in hard currency. This pivotal shift proved to the world that a publicly traded company could generate reliable, liquid wealth for everyday citizens without forcing them to deal in physical goods. The transition from physical bags of pepper to reliable cash dividends permanently altered the structure of global capitalism. VOC shares quickly became the gold standard of financial security, acting as premium collateral for loans and mortgages across the continent. The continuous, predictable wealth generated by the Asian spice trade fueled the Dutch Golden Age, directly funding the vibrant art of Rembrandt and the construction of Amsterdam's iconic canal houses. The megacorporation had successfully commodified the ocean's bounty. By utilizing joint stock mechanics, they turned the physical reality of a distant pepper vine into a speculative paper asset that would dictate the future of human commerce.